Good morning, everybody, and welcome to the Australian Market Preview for 22nd December. My name is Carl Capilingua. I'm the market analyst over here at ThinkMarkets. Very excited to be with you today. Only 3 more sleeps to Christmas, and markets starting to get pretty volatile as we head into this lower volume, higher volatility period of the year. We'll talk about that and more after we talk about the ThinkMarkets Difference, which is substantial $8 flat rate trades, your own holder identification number, unlimited phone support, and of course no hidden platform or subscription fees. 4 fantastic reasons to choose us over your current broker. But hey, let me give you 10 more. Your first 10 free trades when you switch to us before December 31 are going to be free. So get onto the website, download the ThinkTrader app and get trading. The agenda for this morning is to check out the key market moves for the last 24 hours. We'll have a look at some of the charts as well, bring it closer to home, have a look at some of the companies going ex-dividend and some of the early broker moves before we check out the calendar for the rest of the day. A pretty subdued performance on the ASX yesterday, down less than 0.1% overall. Within the sectors, energy suffering, down 1%. Of course, we are facing further restrictions of movement because of what's going in Sydney, but more importantly for what's going on in the rest of the world. Of course, Sydney's important to us, but in the rest of over the rest of the world, there are European countries shutting their borders to the United Kingdom because there's this surge in this mutant strain that they're calling of COVID-19 over there. And of course, infections were not going so well anyway. So we've got lockdowns in London and then potentially restricted travel between the UK and other countries. And that is having a negative impact on oil prices, even more negative as we'll see when we get to the slide for commodities prices. Gold up 0.74%. US dollar is quite weak at the moment. That's helping gold and silver. We've seen some of the other sectors there suffer. Information technology, healthcare, property, utilities down on an AGL profit downgrade. To the upside, though, materials, we're still seeing strength in iron ore prices. They popped again overnight, and in China late yesterday, some material sector up 1.43%. Iron ore stocks benefiting there. Looking around the region, the Nikkei was relatively flat. Shanghai Composite up slightly. Hang Seng down probably about just as much. In the US, it was looking pretty dour on the open. Markets open considerably lower, over 1% lower in all 3 of those cases, but managed to claw back those losses, and very narrow losses in the end for the Nasdaq in particular. The Dow Jones actually got a gain, and the S&P 500 down 0.4% as Tesla was added. Tesla slid pretty much for the course of the day, and that contributed to the loss there in the S&P 500. But volatility spiking 17%. That's a bit concerning for me. Is it because of what's going on in the UK? Is it because of what's happening with Telstra coming into the S&P 500? That volatility index is based upon the S&P 500. Is it to do with the stimulus package that was finally announced? It was about $900 billion. We're going to see the $600 stimulus checks coming out. We're going to see continuance of the $300 extra support for unemployment. We're going to see continued lending to small businesses. Widely flagged in the markets. I'm not sure if that was it. So we will have to watch that development there on the volatility index very closely. Around Europe, you can see the impact of the worsening COVID situation in the UK and the fears that it will spread to the rest of Europe. We have had some health officials across the globe come out and try and reassure people that the current vaccines that are in play should be able to deal with this strain of the virus. So fingers crossed that's going to be the case, but it didn't prevent the DAX falling nearly 3%, the CAC 2.5%, and in the UK, interestingly, a mild fall 1.7%. Have a look at the base metals, starting off with the London Metals Exchange. Not a fantastic performance, lead tumbling 4%, but the rest of the metals there down somewhere between 1 and 2%. We note that copper was also down 1.6% in the US. Iron ore popping was the broader move is more than that, but just what sort of happened since the last update, up 4% in China and the Dalian Commodities Exchange, and a catch up there of 2% in the US dollar price. Gold down slightly, silver still showing its strength up 1.4%. We mentioned crude oil prices were down on fears of movements on restriction on travel, and you can see there a 4.3% fall in both of the West Texas crude and Brent crude oil. The Australian dollar pulling back 0.5% as markets really turning risk off, and the Aussie dollar is the ultimate risk-on currency, so not good for the Aussie dollar there. US dollar index more broadly flat, but that was after a sharp rise earlier in the session, so closed well on the lows. The opposite, mirror opposite to what was happening on stocks, which closed closer to their highs, bond yields edging back a little. And this demonstrates what I was talking about there. The huge rally off the lows in the session is very encouraging from a price action perspective. We've talked many times in these updates about the day-to-day ebb and flow of what's happening in the markets, and you can almost, well, I should say almost always, but quite often you can predict what's going to happen in the next session by simply looking at what's happening in the last session. So what we can see here, the price comes down initially at the open, and the only way that can occur is if there is lots of supply in the system. It hits a level where the buyers are prepared to come back in. Now, what is that level? Where we talked many times about the importance of this level here. We've got plenty of other peaks from here in the past. Those peaks tend to act as potential trough points in the future. So they are points of supply, tend to act as points of demand. So points of supply tend to act as points of demand going forward. We've seen it a couple of times already. Now that stays the case until it doesn't. If there's too much supply and all of that supply interacts with the demand at that point and there's no more demand left, then we have to slip potentially to the next level, and then the next level, and then the next level from there. If we can hold that level and the supply that we know is sort of up here, if the repeated supply attempts to break through, if the demand can soak that up and we remove all that supply, that's when we tend to see prices go up. So how do I know there was demand in the system? Well, the price didn't close down here. We didn't see something, a candle or a bar that looks like that. So we didn't see that. We closed all the way up here. And the only way you can get from let's call it point A to point B is if there is a bucket load of demand in the system. And that's what that's telling us. And because we closed at the high, we would think that it's unrequited demand. You often say when the price closes on the high, the only thing that stopped the price closing higher was ding, 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 the market closed. So that demand can flow through into the next candle as well. So obviously we'll continue to watch it in these updates, but I would suggest that price action is a big positive for the S&P 500 and largely reflected also in the price action for the NASDAQ. No, it wasn't one of these sorts of candles, but we gapped open gapped lower on the open, I should say, which is in many ways more bearish. It's more frightening if you're an investor to see that big gap down. You think, oh my gosh, what's going on? Should I be selling? But before long, we got that much lower. Before long, the buying comes in and you're closing near the highs. So that's still, just as a positive candle as the other one. The net impact of those in terms of supply and demand are largely the same. Good to see it bouncing off that 12,608 level. I can't see anything in the charts at this stage to suggest that the short-term uptrend and the long-term uptrend that are in place in both the S&P 500 and the NASDAQ won't continue. Have a look at the trends for the local market. Well, not a fantastic night for our futures, but not terrible either. So we're looking at the shape. We've got this sort of somewhat of a V shape or a W shape or double W shape, whatever you want to call it. But the bottom line is we found our demand in here of 65.20 and we have bounced. We would have liked that high close and we didn't get it. That's frustrating, but it's not a terrible session. If you had to give it a score out of 10, you're probably giving that about a 5.5 or a 6. We're pointing to about a 0.3% decline on the Australian market. If we have a look at what happened yesterday, well, we can see one of those little candles, can't we? It's a smaller scale, but it's still showing that there is demand in the system. Where is it coming in? Well, it's coming in at the previous trough levels, and that's what we tend to see. Previous points of demand tend to act as future points of demand. We're also seeing the dynamic support zone here from the short-term moving average zone coming up. This is our value zone. This is where we like to buy. The price tends to trampoline off of those levels, as it does if we slip that into the long-term trend zone, which is up. So I'm going to say the same thing for the US markets. I can't see anything sinister to suggest that the uptrend is going to change anytime soon. Sure, we'd love to see big candles that look like this, but hey, that's the ebb and flow of the market. You don't get them all the time. Sometimes you have to wait, exhaust the supply that's pushed it down here, and then the demand has nowhere else to go. It still wants to get in the market, and it's going to push prices up. What's going to happen today? Look, I think it'll be a better day than that minus 0.3% is suggesting, based upon the performance in US markets. Okay, having a look at some of the dividends, and there are a number of them today. I'll let you press pause. They look mainly like ETFs, almost all of them. In fact, Metcash is one in there that's going ex-div today. But I'll let you press pause, and I'll go to the next slide, the next slide, and the next slide for the rest of the dividends. Okay, let's have a look at some of the early broker moves. I could only find ones from Citigroup on the news wires this morning. They have decreased their target on AGL. We mentioned before, weaker utilities sector yesterday, and that was on the back of this profit downgrade. So the price going from $14.49 down to $12.16. They retained their neutral rating. They said after the profit downgrade, they reviewed their price target and noted continued soft demand and pricing weakness. On City Chic, they were a bit more upbeat. The price target going from $3.20 to $4. They retained their buy rating on the stock. They said that they were very happy with this announcement of the acquisition of the UK plus-sized brand that they bought, Evans, I think it was. Yes, it is. They see potential earnings upside of between 16 and 17% for FY22. Significant synergies to be unlocked from the deal. On QBE, they lowered their price target from $12.55 to $10.60, but retained their buy rating. The broker said they were not impressed with the company's lower profit guidance, disappointed that management couldn't execute on the strategy as the local market recovers. Despite this, the stock remained attractive, I guess. That is why they retained their buy rating. Have a look at some of the economic data out for today, and then this evening into the US. We will have Australian retail sales today. That is a final figure. Looks largely flagged in the preliminary we had earlier in the month. Pretty quiet then into final GDP. That's ancient history, but it'll be interesting to see how the US economy has responded to sort of the post-worst of the COVID. And Chinese Conference Board leading index, they're always interesting. Consumer confidence, that's a final reading. We've had the preliminary. Existing home sales, Richmond manufacturing index look fairly quiet tonight, I think. Okay, well, that's it for me this morning. Of course, you can catch all of our updates as they break during the day in our market news section of the website. Follow me, all the Think Markets handles there on Twitter. No scheduled updates for the rest of the year, obviously heading into Christmas and New Year, but we do have the Think Learning series that will pick up again in 2021, so make sure you get onto the website and you must register for those to be eligible to join me. The disclaimer before I leave you says that everything we've discussed today is general in nature. Of course, we are a regulated Australian broker. We do have some products that could see you lose more than your deposit. So please read all of this very carefully. If you've got any questions, hey, give us a call or consult the website for further details. That's it for me. All the best for your trading until we catch up again. Bye-bye for now.